Alright, in this video we're going to look at order flow and how the market auctions. Before we get going, I want to do a little bit of housekeeping. Here's the disclaimer for the video. You need to stop the video and read it, and it's also in the description under the video. Know that I'm only going to go over one or two aspects of trading here, and by far cannot cover everything you need to know to trade real money in one video. This is for educational purposes only. I'm not endorsing that you get in a trade, out of a trade, or that you should even trade at all. What works for me may not work for you, and what's currently working for me may not work in the future given the ever-changing market conditions. There is substantial loss that can occur in trading futures and options and stocks and just about anything you can think of. So you might want to see a financial advisor to make sure you will get yourself involved in here. Okay, that said, I have now a trading course that I'm selling. There'll be a link in the video in the description section for that if you like. I'm not going to spend a lot of time on that. Next thing I'd like to go on is, if it'll click here, is if you'd like if you see any value in this video, please give me a thumbs up and subscribe. If you want to be notified when similar videos come out, just click the bell down there. All right, we'll get right to it. In a traditional auction, there's usually an auctioneer, or there's always an auctioneer as far as I know, and he'll be offering for sale an item or service. And that service, he'll say, like, I have 100, do I hear 200? And somebody will raise their hand and say, yes, I'll give 200. All right, so they're saying they'll give 200 and no more. That's what they'll give, 200. And then they'll say, I have 200, do I have 300, for example. And this is laying the groundwork for what we're going to get into and how the markets auction. All right. This is a picture of an auction that occurs every year in Arizona, and it's Barrett-Jackson, and they sell antique cars. So this is just to give you a little idea of how they work, and some people are familiar with this already. But there's a person at the top here with the microphone in his hand. He'll be saying, you know, I have 1,000, do I hear 2,000, and so forth. And he'll be auctioning off a single vehicle usually. Sometimes I've seen him auction off 2 or 3 at one time, but it'll be for one price. So they'll be auctioning off an item of service, like the antique car in this example here, and they have ring men around the side here with the red ties, and sometimes there's a ring girl too, but I don't see her in this picture here. And he'll be saying, I have 1,000, do I hear 2? And somebody will raise their hand, and these ring men will yell out, yes, I have a bidder here that's willing to pay at least $2,000 for the car now. And as the auction moves on, at the beginning of the auction, usually, the price of the item or service is pretty cheap, or everybody at least thinks it's pretty cheap. So everybody in the room here in this example is holding their hand up, wanting to bid on the item at the particular price it's at the moment. As the auction moves on and price moves higher, there will be fewer and fewer people in the room holding their hands up. So fewer and fewer people are finding value in the item that's being offered for sale, until there's only one person left. Now, this one person was the last person to make the bid. There is nobody else in the room who is willing to pay any more than she does at this moment. So she is the, in this case, looks like the winner. She might not think so when she gets home, but at the moment, she's the winner of the item that she just bought and so forth. So that's how a traditional auction works. Now, we're going to look at a little more on a graphical representation of a traditional auction. Here we have 100 bidders to begin with. As price moves higher at each price level, there's fewer and fewer bidders, like I showed in the picture, until you get down to that one bidder. So at this point, there may have been more people wanting to sell at a higher price up here, because you always want to get as much as you can out of something, but there was nobody willing to pay anymore. So that's as high as price went, to $10,000 in this example. So there was people down here willing to bid, take the other side of the trade, but at a certain point, they just drifted away, faded away, until there was nobody left but that one person, no one else willing to take the price any higher. All right, in a two-way auction, sellers can sell to enter if they believe there is value in doing so. Now, like I say, I have a trading course, and in the beginning of the trading course, in the foundation portion of the course, I discuss how to sell something before you own it and everything like that, so I'm not going to go over that here. And you can also go out on the internet, I'm sure, on YouTube or Google it, and find out how somebody can sell something before they own it as well. But at any rate, they're sellers accepting what somebody's offering for something for sale. So if I'm saying I'll give $9,000 for a car, he's saying I'll take it. He's willing to come down to my price, so he's selling into my bids, into the bids. So that's how this is working. A seller accepting what the buyers are bidding. There's 100 to begin with, could be 1,000, or just use a number, it could be 20 million, it don't matter, whatever. But as the price goes lower, the seller finds less and less value. He's selling, he wants to sell high, seller does. So he's selling higher in hopes to buy it back at a lower price. So he's selling into the bids, pushing price down, but as price moves lower, there's fewer and fewer people finding value by selling into the bid. So you get a graph like this. Now, in a two-way auction, buyers can buy to enter and sellers can sell to enter. All right. The seller he or she will have to sell to exit. So a buyer will have to sell to exit at some point, and the seller will have to buy to exit at some point. The goal of being to buy a buyer is to buy at the low and sell it to high. But the seller's goal is to sell high and buy back at a low later. Okay. So this is a graphical representation of how a two-way auction works. Buyers are buying into what they're asking. They're wanting to sell something, so they're saying, I'll take it, I'll take it, I'll take it. But there's fewer and fewer wanting to take it as price goes higher. The sellers are saying, I'll sell to you at these prices. I'll sell into your bids here, and I'll keep selling into your bids as long as I see value. But as the price moves lower, there's fewer and fewer people wanting to sell into their bids. So that's how that works. And then it's limit orders that we're using. And we're going to talk more about limit orders here in a moment. But this generally will make a bell-shaped curve of some sort. Maybe not this pretty or this bad looking or whatever. But at any rate, at this particular price, it was $6,000 more. There was $6,000 level here. There was more trades took place at that level than any other level. So this was where the most value was at that point on this graph here for this illustration. All right. Buyers and sellers have opposing points of view. In a two-way auction, buyers want to see price move higher and sellers would like to see price move lower. So they have opposing views. They're both battling against each other, and it is a battle as we get down through here and we get into the game of the situation a little later on. And they will do everything they can to achieve that goal. So they're battling against one another, and we're going to get into it as we go along. And to better understand how they go about achieving their goals, we need to first look at the role the buyer and the sellers play. So first, before we get into the battle of how the auction works, we need to know the rules of the game to a certain extent here. All right, and I know some of this is just not is obvious, but it means more as we get down in here. A bidder, he's willing to bid on something. That's the buyer. He's willing to buy, he's willing to pay, he's willing to bid. He's saying, I'll give this much. The asker is the one asking. He's the one saying, I'll ask this much, and so forth. All right. The asker is always going to ask as much as he can possibly get out of it. He wants as much as he can get. The bidder is saying, I want to buy it for as little as possible. So the bid is always going to be below the ask. So if they got a hot dog for sale here, for example, the bidder says, I'll give $1 for it. The asker says, I want $2. All right. The ask price will always be higher than the bid, and so forth. You can read it right there. Anyway, this means there's more as we get down through here. All right, now we're going to use the car for the example. I'm looking to buy a car, but only willing to pay $9,000 or $9,000. In other words, I'm bidding $9,000 and will pay no higher. In trading, this is known as a limit order to buy at a specific price or lower, meaning he's willing to give $9,000 for a car this guy has for sale over here on the right, but he's not willing to give a penny more. That's it. $9,000, not a dime more, nada. Okay. The seller is selling something. You try to get as much as you can for it. He's asking $10,000 for the car. He says, I want $10,000 for the car. I won't take a dime less. You either give me $10,000 or we're not going to make a deal here. You can give me more, but I want at least $10,000. So he's placing a limit order saying 10. 10's the limit. Other guy's saying, no boy, 9's the limit. Well, I'm holding firm at 9. He's holding firm at 10. Nobody's going to make a trade. It's over. There's nothing happening. You might as well go about their own separate ways. All right. Now, this guy here, I say he bought a car, but we'll just say that he found a car for sale, a brand new one, that he just cannot resist. He's got to own it. The only problem is he needs a down payment. Well, he's been asking $10,000 for his car, but this guy is willing to pay him $9,000 right now, and he really wants that new car. So he says, buddy, I'll take your $9,000, whip it on me. All right, so he's willing to come down to this guy's price. He's initiating the trade. He's the one saying, yeah, I'll take it. This guy can hold 9 forever if this guy's not wanting to come down. But he decides to come down, so he's initiating the trade. So he can get some money and go buy him a new car. All right, in the second scenario, the guy is wanting to, got him a new job. He's got to go to work Monday. But where he works is at least 15 miles, 20 miles away. Well, he can't walk to work, and he needs a car. Up to this point, he was only willing to give $9,000 for the car, but he don't really want to walk to work every morning. So he says, "I'll tell you what, I'll give you $10,000 for the car because I really got to have it." So he's initiating the trade. The guy in the green here is saying, "I'll come up to your $10,000 price and I'll pay it. Now I ain't gonna pay you no more, but I'll give you the $10,000 for what you're asking for it." So he's initiating the trade. You can say he's being more aggressive, but he's the one initiating the trade. All right. All right, now limit orders are passive orders in a sense. Now, this is an old pick I made a long time ago. I've learned since then that you can be very aggressive in placing limit orders, and we're going to get into that here in a little bit. But limit orders are passive orders for the moment. I placed a buy limit order in the market and will only buy at a specific price or lower. I will let the market come to my price. That's like the guy with the $9,000 car here earlier. He says $9,000, that's it. That's my limit. I won't pay no more. You got to come to my price. This guy says $10,000, that's my limit. You got to come up to it, or we're not going to make a deal. So those are what limit orders are. And you can stop the video and read that if you like. All right. I've been calling, you can call them aggressive orders if you like, but I've learned as we get into the battle of things that there is a tactic to these things when you get into the people that trade that actually move the market. They're being tactful in how they place their orders. Now you can say they're being aggressive, but they're calculating in how they're doing it. So I'm not a big fan of just saying aggressive when in a lot of cases it is the case they're being aggressive. But to make it more plainer as we get down through here, they are initiating the trade. So I'm willing to come up to your price and pay what you're asking, but I will pay no more than what you're asking. So he's asking $10. He's coming up and saying, "I'll give you the $10, but I'm not going to give you a dime more than $10. That's it." So he's not going to get caught in a situation where, I want $10.50 or $10.25 or $11 or something like that. He just says, "I'm giving the 10 and that's it." So he's coming up and paying what he wants. All right. He's going to buy at the ask. This guy's asking, this guy's buying, he's paying what he's asking. Now the seller's initiating the trade, like in the car deal earlier. The seller says, "I'll come down and pay you $9. I'll take what you're willing to give me for it." So you're willing to give him $9. He says, "I'll take it." So this guy is initiating the trade. The seller is coming down to the bid. He's willing to pay what he's bidding for the car or whatever the item might be. All right, now we're going to just bring it home a little bit more. You can stop the video and read this. I'm going to step through it real quickly. But I'm willing to pay what the seller is asking by placing a limit order to buy at the ask. He's saying, "I'll buy at your ask, what you're asking." The red guy's asking a certain price. He says, "I'm willing to come up to your price and I'll pay that and no more," just like we talked about a minute ago. I'm willing to sell for what the buyer's bidding. He's willing to come down to the buyer's bidding price, the $9,000 for the car or what have you. So this is the seller coming down to this guy's price. And then we have the buying at the bid. This guy says, "I want the $9,000 for the car. I'm holding firm. I'm not going to give a penny more, and that's it." That's a limit order to buy at the bid. Okay? He's wanting to sell at the ask. It means he wants $10,000 for the car. He'll take no less for the car. He's willing to sell at the ask, but that's it. You can take more, but that's it. Okay. Now, we'll look at a dome here real quick, and I'll explain more what a dome is later on in the presentation. But for now, we have all of buys on this side. The buyers are on this side. The sellers are on this side. If I want to buy at the ask on this thing here, well, the buy is in blue, for example, and the yellow is the last price traded, and the green is the ask. So the buy is in blue, the green is the ask, and the yellow is the last price traded. So this is significant later on when we start watching the order flow. But for right now, if you click this button on this dome on the ask, you're saying, "I'm willing to come up to the ask and buy at this price right here." If you click the bid, you're saying, "I'm willing to come down to the blue price and buy it there." Now, if this is a fast-moving market, these numbers are going to be changing all the time. But just for a still picture, this is what would happen right here. All right. Now, I decided to include this picture here. I took it years ago, 2011, but it does illustrate. I'm not sure what the circumstances was at the moment. I think it was in a live market. But I think it was during a news event. I'm not sure what the deal was, but there was a live spread here. This could be because the contract month went dead, and there was still volume being traded in this, but the spread got. It wasn't in the front month, and I explain all this in the foundation portion of the course, what a front month is, and all this stuff. But at any rate, the bid and the ask is really wide. The bid is in blue, the ask is still in green, but look, they're like 8 or 9 ticks apart here. Even one contract, it's like $90 to $100 difference right there. So somebody come up and bought one contract by this one here at this price here, but there's nobody left. Nobody placing limit orders here to buy. No one's saying I'll take. Only until you get plumb up here do you have an order, and then there's just one. So unless somebody beats you to it, you won't get filled for at least $80 to $100 right here. And more than likely, you're not going to get filled to plumb up in here somewhere. So you got to watch when you see that there's no limit orders on the ask or even on the bid side. You want to see the bid and the ask one tick apart, one above the other, like right here, one above the other, not this far apart, especially if you're intraday trading or scalping. Anytime really. I don't like to see these wide bid ask price ranges. So this is something I want you to look out for. And you can stop the video and look at it. All right. Now there's context. Sometimes you'll see a lot of orders move through the market and they're getting out of the market. And sometimes they're getting in the market. You got to be able to distinguish which is which. And the only way you're going to do this is get some screen time and get some context of why things are happening the way they're happening. And I wrote down a few scenarios here and stuff. This is just one of many scenarios that could happen. But he's short the market, and he's put a buy stop. He's moved it up to break even because price moved in his favor for 5, 10 ticks, whatever. And he decided that he's nervous. He wants to, or whatever. Maybe it's part of his strategy. He moved his stop to break even. All right, price comes back and stops him out. You might see that several people had done that. Well, those orders are going to be buy stops, and they're going to turn into market orders. And if you're looking at a dome or a footprint chart, which I'll get into it here in a moment, you'll see a large, relatively speaking, amount of buy stop or buy orders turn into market orders coming across your screen all at one time. Well, you'll think that's a good thing if you're long. Boy, it's going to go higher, but not necessarily. It could be somebody getting stopped out. That's just one scenario. There's other scenarios where you could see this occur as well. So let's move. Let's stay right there for now. And this is just the opposite. It went long, and he moved his stop up again, and you'd see a lot of stop market orders come through the market. Well, you want to see follow through. After you see a large number, relatively speaking, of orders come through the market, you want to see more follow through, and not just 1 or 2 or 3. You want to see several coming through and really pounding away at it and seeing if they're having any movement in price to know if it was just people getting in or getting out and so forth. And then there's the passive, the limit orders and stuff. You can stop the video and read that. And then I am short the market and have a stop set at a specific price just above resistance. All right, if price touches that specific price, that buy stop becomes a buy market order. Okay, and the circumstances, then we got the opposite right here where a guy's long or girl or whatever, and it touches the price and turns into a market order as well. So they have stops. So when you get in, you should always have a stop in the market somewhere to protect you in case of, the market moves against you and you're proven wrong. And then there's ones for limit orders here as well that you can read over and stuff. I'm going to move right on through here. But here's an illustration. We have a channel here. We have a daily support level and a daily resistance level where prices hit several times and not broken through and move back down to the other end of the extreme. So now if you was going to go long here, you thought, well, price is going to bounce off this support level again, you'd go long right here. You get a little over anxious and get in, for instance, and you put a sell stop right here. Well, you're not the only one that's put a sell stop here. There may be 100, 1,000, 10,000, depends on the market. People also put a sell stop right here. Well, if you're watching your dome or your footprint chart, you may see a large number of orders flash before your eyes all at one time of sell orders. Well, if you don't understand that they're getting stopped out, you might think, well, hell, there's a lot of sell orders coming through the market. That means prices is just going to fly down. all these people coming in, but then there's no more orders come through the market, or there's very few more sell orders come through the market, and the buyers start to step in. These are the things you got to learn what to look for. Same thing, opposite end, went short, put a buy stop up here, come up, a lot of buy orders come through the market, but no more follow through, maybe just a few come on in, and then it rolled back over, sellers took control of the situation again. So this is the context you got to look for in the markets. You're not always buying to get in or buying to get out. And sometimes I talk about the limit orders. Maybe they're buying to get out. I bought down here, and I want to sell up here, and you'll see a lot of limit orders go off to sell. Well, you think, well, all those limit orders went off to sell, price should move down. That was filled. The limits was filled. Well, not necessarily. They may be just everybody getting out, and then price goes nowhere, or maybe then buyers step in and it continues to go up. So these are the things you got to watch at these areas, what to look for, whether they're taking profits, whether they're getting stopped out, and so forth, whether they're getting in or getting out. All right. Another difference between a traditional auction and a two-way auction is that both buyers and sellers can add more contract shares to be bought or sold at current bid or ask. Whereas in a traditional auction, in most cases, there is only one item to be sold at a time, and then after it is sold, a new item is put up for auction. So what I'm saying is, you can put a lot of things up. They can put a lot of contracts up for sale at one price, and somebody has to buy them all. All right, or sell them all to move price again. And we'll get to show you, illustrate that here in a moment. This ability to add contracts adds a new dynamic not found in a traditional auction. If a seller, for example, has the determination and the account size, he or she could theoretically stop price from moving higher indefinitely by continuing to add contracts for sale. The same is true as a buyer. A buyer could, if he or she has the determination and the account size, keep buying, placing bids at it as long as the buyer continues to place contracts at the bid. Theoretically, they could stop price from moving lower indefinitely. Another tactic a buyer or seller can use is to have in a two-way auction is to cancel the limit orders they have placed in the market, either surrendering to the other side or purposely creating a vacuum in the number of limit orders to move price to the next level. And I'll clarify how they do this here in a minute. Let's move down to the next chart. All right, again, there's 1,000 bidders, 10,000, whatever, at the beginning here. Everybody finds value. Price moves higher. There's fewer and fewer people finding value. But in this auction, there are the number of contracts that must be bought before price can move higher. So the buyer wants to buy low and sell high. But remember, there's a seller here that is selling to enter. He's wanting to sell and then buy it back lower later. So the buyer is fighting against the seller to move price higher. So if the seller wants to prevent the buyer from moving price higher, all he has to do is add more contracts at a level, or 1 or 2 or 3 levels here. Or just one level will do, but they'll do it over 2 or 3 levels usually. And they'll make it painful for the buyer to keep buying. He'll have to spend more and more money in order to move this thing higher. So as this price is moving up, if everything stayed the same as it was, no one pulled or no one added orders, there's 124 contracts that need to be bought at $5,500 right there. Now as price comes up, these orders can start to disappear, or they can come up and start pounding on them, and then they can start pulling them. Or they can start pounding on this order, not buy them all at one time, but maybe buy 50 or something, and then somebody will pull the orders. That's what the buyer's hoping. But then again, I could come in, he bought 50 of them, and I could say, I'll throw another 100 in there. Now you got to buy not only the ones that was there that you didn't buy already, but the extra 100. And you hit it again with another 50, and I add another 70 on there. So I'll just keep adding contracts till I can't take it no more, and you'll keep buying contracts till you can't take it no more. Somebody has to give in first. So that's how the auction works. Buyers keep buying to move price higher, but they got to buy everything the sellers are throwing at them. And the sellers want price to go down. The buyers want price to go up, the ones that are entering the market. And I'm talking about the people who move the market, not just the traders like, the average trader like me and you. You may be a big time trader, but you won't need to be watching this video if you are. You couldn't become one if you didn't know this. Okay. All right, sellers want to sell high, buy low. they've got to sell into what the buyers are bidding. They're bidding on, they're putting bids out here saying, I'll sell you 55 of these at $2,500 if you want to come down and take them. So if you want to move price lower, you got to come in and take whatever's at the bid so price will move down. So you got to be the buyers putting in limit orders to prevent me from moving price lower. All right, and the seller keeps trying to buy them to move price lower. So sooner or later, one of the two of us is going to get disturbed and give up on the situation, and the other is going to take control. And that's how you determine who is going to win out, by watching the limit orders and the amount of market orders coming in the market. All right, retail trader. That's what I'm trying to pause it there for a minute. I can remember. Most traders that'll be watching this are retail traders. They do not have the millions of dollars it takes to move this market. Okay, so you'll be watching what will be, I guess, the professional traders are in there. Not that you can't be professional, but you're considered a retail trader because you just don't have the millions of dollars to move the market. So you'll be watching the people that have the money to move the market and seeing how effective they are at getting through these limit orders. All right, and again here I am offering to buy 46 contracts at 61.86 contract. Once all 46 contracts have been sold, I have an additional 74 contracts. So we'll just move it on down here and focus in on this here. This is the dome again. These are the limit orders. This is crude. It looks like, yeah, crude oil. The green is the ask, the blue is the bid. The price is at the ask because of the yellow. There's 46 contracts waiting here, and we're going to say that they're not pulling or adding to. We're just going to say there's 46 contracts. For me to get price to move lower as a seller, I've got to come in and accept the bid on 46 of these. I got about 46 of these at $61.86 a contract, or a piece there. So that's what the price is. This is and I'm going to buy that many contracts, 46 of them. Then it'll move down to 74. Then if I want price to move down to the next level, I'll keep selling into those bids and accepting them and moving price down. Now this is assuming that they don't keep adding to, making it harder, my life harder to try to get the price to move down. At the same time though, they are going to make my life harder. They're going to put more orders in to try to keep me from moving price down, and then they're going to try to start selling into these limit orders here. So I have sell limit orders here to prevent them from moving price up, and I'll keep trying to put sell limit orders in to keep them. But sooner or later, I'm going to run out of the psychological part of me, plus the money part of me is just going to run dry, and they're going to win out and take over perhaps. Or maybe I've got a stronger, bigger wallet or bigger psychology, and I can move it on down. So that's how that works. All right. And then here's another pick I took a long time ago again that you can stop the video and look at. It explains what I just said there, assuming everything stays the same. All right. All right. Now, as the bid-ask information flows from the exchange into your computer, it can be displayed in a multitude of different ways. We're going to look at a time and sales window. We're going to look at the dome again and the depth of the market. We're going to look at a split profile. We're going to look at delta and liquidity before we get into the battle of how this all works. Now let me see here. I got a time and sales window. Let me first move down to the next slide. Time and sales takes the data received from the exchange in real time and displays whether the order was at the bid or at the ask. So it's giving me the who's being more aggressive, who's initiating the trade, who's coming up to the ask, who's coming down to the bid. This is what the time and sales window is going to tell me. The date, the time it took place, the date, the direction, which whether they're buying at the ask or selling at the bid again, the price at which the trade occurred, and the volume, the size, the number of contracts that was traded, or shares, and so forth. And then there's a picture on the next page here I'm going to show you, and you can find this in the resource section of on this page with the video, this link, or you can just copy and paste or whatever. But there's the link to this right here, the Ninja Trader blog, and it shows you this picture here of the time and sales window, which is right here. If it's yellow or brown or whatever the color is there, that is buyer. Let's see. Buyers are coming up to the seller side will be green. Sellers coming down to the buyer side will be red. If I haven't got it backwards on myself here. It tells you the time. It tells you the price and the number of contracts traded at each level in real time as it flows through the market. Now you can watch this and get an idea of what you're seeing here. I think you probably can change and only see bigger size. I'm not sure. You go to properties and so forth, and I don't know if it does block size right here, and mark the block size. It's 80 right now, and you can change that for each market. Block alerts and make a sound or something, I'd imagine. I don't really fool with this time and sales window, but there is a method by which you can trade just using the time and sales window. Though it's not, now that they've come out with newer platforms and better ways of looking at the market, or better is a relative term, but other ways of looking at the market. I don't look at the time and sales, but this is where all the information is derived that creates the other platforms that I'm going to be showing you, or everything. It's all the information that's derived that makes the charts and everything, indicators, everything is derived from this time and sales, the information coming to the time and sales window. All right, here's a video that you can go to on YouTube to watch that NinjaTrader made about their time and sales window as well. You can watch. Now we're going to look at a DOM, or DOM, or depth of market, DOM, which stands for how deep are those limit orders. Just like water in your swimming pool or something, it's 5 foot deep. How deep are the orders on either side of the market? There's 66 orders here, and there's 75 orders here, and this is a crude oil market. And let me see, let me bring over a DOM. And the depth of the market, limit orders over here, buy limit orders over here, and this is crude oil, I think. Yeah, crude oil. And let's look at the ZN. Now, before we go, notice that before I click on ZN here, notice that there's only 2 to 3 digits at the bid and the ask here. Now we go to ZN, there's 4 digits, and there's as much as 3. This is pretty low right here, 1720 right at the moment. Right now, but notice how much thicker this is. It takes a lot more money for somebody to come in and buy at the ask here than it does for somebody to come in and buy at the ask on crude oil. There's only 21, so it takes a lot less money to push around crude oil than it does ZN. So if you watch those two different markets, they're two opposites of the same extreme. That's the depth of the market right there. That determines the personality of the market, how it's going to move on it. So if you get some screen time, you'll see that. You can stop the video and look at this here, the bid and the ask, the price, volume, and stuff, everything. All right, now we're going to look at a split profile. In a split profile, it measures the number of contracts that come to where the bidder or the person selling or the person buying measures the number of contracts from all of them, buying and selling for that matter, but coming to the other person's side. So let me bring the DOM back over again. This is the buy side. It's still the buy side, even though it's registering red. What it's registering the red for is sellers are coming down to the buyer's price and accepting it, like the $9,000 for the car earlier. They're coming to their price. So it's coming down to their price, so it's coming over to the buy side. That's why it's on the left, and it's red. It's sellers coming over to the buyer's side and accepting what the buyers are bidding. The green reason is because the buyers are coming over and accepting what these limit orders here. So buyers are coming over and accepting the price the limit orders are at for the limit orders and buying up the limit orders. Sellers are coming over to the buyer's side and accepting the limit orders over there. So these are the people initiating the trade when you see this split profile like this. So there was $55.21 in this particular, we'll say this is a candlestick here, or a price bar. There was 400 at the time this candlestick got completed. There was 400 people, or not 400 people, 400 contracts traded at $55.21 at the bid. There was 348 traded at the ask at $55.21. Now the bid and the ask is from lower left to upper right, but we'll get into that here in a moment. So, and this measures a graphical representation. The more contracts traded, the farther out the red will go, where the buyers come over, or the sellers come over to the buyer's side. So they're the most was on buying at the bid, or selling at the bid, or whatever, where the sellers come over to the buyer's side. was at 55.11. That's where the most contracts are traded at the bid. The most contracts traded at the ask was at 55.12 right here. All right. So these were buyers come over to the ask side and come into their price. This is where sellers come over to the sell side and took their price, the bid. All right, that's what a split profile is, and we'll get into that a little more later on in the presentation when we look at a DOM. All right, now we're going to look at the delta. The delta compares the difference between two sets of numbers. To find the delta for a range of price movement, add up all the sellers buying at the bid, then add up all the buying at the ask. Now subtract one from the other. Okay, again, this is the same candlestick we looked at a minute. Started with 400 right here. I just redraw it around it to make it so I wouldn't save some time, but it still explains the same thing. There was 400 people come from the seller side over to the buyers and accepted their bids, and it added them up until this candlestick is done being made, or this price bar. These numbers can change, but after they're done, it's going to give you the delta in real time as the candlestick is being made or the price bar is being made. So, but the numbers can change until the next bar starts to print. So I added up all this. I added 400 to 130, 130 to 89, and kept adding up all those numbers, and it gave me 10,525 contracts were traded at the bid. There were 10,275 traded at the ask. I subtracted one from the other, and I got a positive number. So it was on the buyer side, so it's a positive number, but it was sellers coming over to the buyer side. So there was 268 more aggressive, or people coming over to the buyer side, initiating the trade on that side. So there was more selling in that stick aggressively than there was buying, we'll say. All right. Same thing if you get a positive number or a negative number. It's going to be a green. It's going to tell me that the buyers were more positive or more prevalent in this stick. Now this number will change as this stick's being built. Again, it's not until the stick or the candlestick or the price bar is done, completed itself, before you know that it's printed and it's in stone, and it's not going to change. So you'll watch those numbers to see the overall strength of buyers and sellers initiating the trade in each candlestick as it's being made. That's what the delta is. All right, liquidity. All right, liquidity. Some people think of liquidity, they say, oh, that's the volume in the market. Well, it is the volume. It's the volume of limit orders on either side of the dome. Again, this is the liquidity right here. How deep is the liquidity? We talked about that earlier. On this. In crude oil, it's not that deep. Whereas in ZN or ZF even, here it's considerably more. ZS 5-year note. All right. So, all right, liquidity described in liquidity is the degree to which an asset or security can be quickly bought or sold in a market without affecting the asset's price. Again, it's easier for me to affect the price in crude oil by placing an order at the ask or at the bid than it would be for me to trade in the ZN. I could put a block of 50 in and at the ask, and price will move up to the bid. There's nobody even at that one there at the moment. There it goes, fills in. But there's only 10 there, so I could trade 10 and move price, you see. So it's not as difficult for me to come up with enough money, relatively speaking, to trade the crude oil than it does for me to trade the ZN, for example, or the ES, which is kind of has quite a bit more than the crude oil, but a lot less than the ZN. All right, so that's what makes it the personality of these markets. So the only way you can buy an asset without affecting its asset prices, the financial markets, is there has to be more of that asset. So more supply than demand, right there. There's more supply here than there is buyers in the ZF. We'll go with ZF. So for me to move price higher, somebody's going to have to come in. They're going to have to pull them orders. That's what moves price. So if there's a lot of liquidity, it's going to take a lot more to move it. That's what liquidity is. All right, you can stop and read all that right there, and so forth if you want. All right, and then again, I talk about it here, a little snapshot, the 10-year note and the crude oil, because they're opposites of they're two. This is extreme of a lot of liquidity. This is extreme of a little bit of liquidity. Now there is some thinner markets, but they get so thin that You know, like lumber used to be real. I don't even seen lumber for a long time, but there was thin markets and such, you know, one single digits and stuff like that. All right, we'll move on. The next slide shows a graph that depicts the amount of liquidity by having a vertical strip of color that gets darker, the less liquidity there is, and gets lighter, the more liquidity there is. All right, so how do you know if there is? Let me go to the ZN or one more familiar. This 5,000 here, that's a lot of liquidity right there at that price. Now, as price starts to move up and gets toward that 5,000, I remember a little bit later that there was 5,000 there at that price because I'm watching like 10 different areas here at one time. And I won't remember exactly maybe where the price was. So as price gets closer to 5,000, does that liquidity stay, get stronger, get less? How do I know? You know, by memorizing, you know, below and above where there's strong liquidity down here. Price moves down. Does the 5,000 stay there, or does it get less or more? So it was difficult to keep track of that with just your mind, memorizing where the most liquidity was and exactly at what price. So what somebody did was they come up with a graph that shows. Now, I don't know who invented this thing first. There's Bookmap, there's Jigsaw, and NinjaTrader's now making one as well that comes with NinjaTrader. Now, of course, the ones you pay for have more bells and whistles and so forth. I use Jigsaw because I like the dome that comes with Jigsaw, and we'll get into more about Jigsaw here in a minute, and I'll explain it later on in the presentation. But for now, this measures the limit orders out from here. You don't see the prices because they don't have the entire thing shown. But there was a lot of liquidity right here, just right through here. As price moved up through it, it became darker. So they either bought the liquidity, eat away at it, or they started pulling orders. And then there was more here, and it got up, and then finally it got real dark. The liquidity just completely disappeared, but so did the buying, and the sellers came back in. Now there's a whole lot of liquidity down here. It's white, but its price keeps moving down toward this white line here, where there's a lot of liquidity. It may start to turn blue, and then get a darker blue, meaning they're starting to pull the orders as price gets closer and closer to it. So this is a very good way of knowing where support and resistance levels are in relation to the amount of limit orders waiting to be filled, and whether they're staying there, adding to them, and so forth. And you can read more about it, and there's a link to Jigsaw. It's in the description as well, not in YouTube, but in the trading course. One might wonder, in a two-way auction, how does price move up and down in supply and demand? We've been going over that really already, but a lot of people get confused. Supply and demand is an underlying force that drives every market. There's got to be more supply or more demand than there is supply for price to move. We'll often hear people say price moves up because there are more buyers than sellers. In the strictest term, this is impossible. The markets are a mechanism for matching buyers and sellers, for matching them. Okay, there's got to be a buyer for every seller. Like I'll go with the car. If he's asking 9, the other guy's asking 10, and neither one comes to the other one's price, nothing happens. So no, there's got to be a buyer for every seller, a seller for every buyer. All right. So the buyers have to, let's see. The markets move up because buy limit market orders, or buying at the ask, consume all the sell liquidity again, and at a price level. Buy market orders or buyers buying at the ask will eat the liquidity at a higher price. Therefore, the number of contracts bought equal the number of contracts sold. So they're buying, but it's when the buyers quit. It's like the profile showed you earlier. As price went higher, there was fewer and fewer buyers willing to take the other side of the trade until no one wanted to come over and accept what the sellers were asking anymore. So that's what happens when we get on down through here. The reason price starts moving up is because there's less buyers willing to come up to take the other side of the trade. The sellers have no one in which to buy from, therefore no trade can take place. And we've covered that. And the same reason the price moves lower. There's just no sellers willing to come down and accept the bids anymore. All right. Again, supply and demand. Here's the supply of people asking price. Here's the supply bids. If they want price to go up, they got to eat away at the supply. If they want price to go down, the sellers have to come over to the bid side and eat away at the bids and buy them all. All right. And that's how price moves up and down. This is the limit orders are supply, the market orders are demand. All right, and this is just the same thing in the opposite direction. You can stop the video and look at it and so forth. Buyers coming down to, or sellers coming over to the buyers and eating up all the supply there. All right, size moves the market. Again, we're retail traders. We don't have big accounts to be moving these markets. I speak for the majority of people, that are looking at this video. Some traders have very deep pockets, and so they play a game different than the game we play. Most, if not all, retail traders will not have the account size to move the market. Retail traders learn by observation over time who is winning out, the buyers or the sellers. And it is a battle, the buyers or the sellers. And we'll move on. Retail traders determine who is the most likely to win out. It's what we're doing here. All right, you can think of limit orders as defense here. If we're playing this game of the buyers and sellers of the big money. The big money, both sides are fighting against each other. The buyers want price to move up because they're buying low and selling high, and the sellers are going to sell high and buy low. The buyers are going to do everything they can to prevent sellers and persuade sellers and make them think, man, how expensive is this going to get to move price lower? They can keep adding contracts, they can keep adding supply, and the sellers can keep eating into it until they just cannot take it no more. Or the people putting the limit orders in just cannot take it no more, and they give up. Somebody has to give up. You have to be watching to see how effective they are, and it'll probably happen over 2 or 3 price levels here. 3, 4, 5 price levels. Usually it's 2 to 3, and you'll be watching to see how effective this yellow place here is. How effective is it staying at the ask? Do they hit it with 100 contracts, or in this case it'd be 24, hit it with 20 contracts, and then it just jump right back down to the bid, and then they add some more contracts in here? And then he hits it again with another 20, and it just jumps right back down to the bid. They're just not having no effect. They just keep hammering away at them. But you keep watching it, and all of a sudden, it sticks. It sticks to the ask. And then they back off adding. They're less confident in what they're doing, you'll find. And the momentum starts to pick up in that direction. Then you'll see we got them on the run. Now they may only have them on the run for a couple ticks, or they may go for several ticks. It just depends. Each market is different, each circumstance is different, and the opposite can happen from sellers coming over to the buy side. How effective are they at keeping it at the bid? Is it jumping back to the ask? Are they adding more? And then you have to get this through experience, watching it. Words do not teach, only experience teaches. I'm just telling you what to look for and give you an idea of what to look for. But only through experience will you know what I'm talking about. All right. And this is just the opposite direction, what I was just talking about coming up and stuff and everything. You can stop the video and look at it or look in the document. All right, absorption. We've been talking about absorption all along, but I haven't used the word absorption, and you're going to hear the word absorption mentioned by other traders and stuff. So I'm going to cover it. It's just supply and demand. There's several reasons for absorption that can occur. People getting out of the market, people getting in the market again. There is a thing called spread trading, where I'll put 1,000 orders contracts to buy 1,000 contracts in the front month and a further contract month back. And I'll play the price, and I don't care which way price goes for the most part, because whichever way it goes, I'm not going to be hurt by much because I'm short one market and long in another contract month. So this is another game that they play that's different than the game I've been talking about, but you will see a lot of orders come in the market, and price just don't go nowhere. They get absorbed by these spread traders. That's one reason it could happen. All right, and then there's a number of other reasons, and I went over some already. But if you see, they call it iceberg, where they're filling this order, whether it be the people spread trading, or maybe one of the big players is getting a whole bunch of contracts gathered in the market at a certain price level, and every time it gets near that price level, he starts buying or selling at that price level, or he or she does. So you'll see absorption there, but price really not going anywhere and stuff. So you have to look for momentum. How much momentum is being put in the move, and how effective the orders are in moving the market, and are they being absorbed and so forth. So you can stop and read all about the absorption there if you like. And again, this we talked about absorption where we had the stop outs and stuff before. I'm not really going to go back into that as much again, but just to remind you that if I had a buy order here and my sell stop above it here, or my sell sold here and buy stop above it, that I would absorb a lot of orders, or there'll be a lot of orders absorbed there. But that don't necessarily mean that price is going to move higher or lower. We have to watch for follow through then and see which one's winning out. All right. To aid in reading the order flow, there's several third-party indicators out there that arrange the market-generated data in such a way that it makes it easier to interpret. All right, first thing we're going to look at the NinjaTrader Dome, then the Jigsaw Dome, and then a footprint chart, and move this thing along. This is the second time I've done this video, and I'm losing my voice. All right, the Dome again stands for Death of Market. We have the price in the middle. We have the limit orders, the supply on either side, or the defense that they'll be using right here on either side. And we're going to be watching to see where the last price was traded and how effective they are when we see a big order come through the market of moving the price up to the next level, whether they're defending that next level or the first level held to start with, and so forth. So you're going to watch this back and forth action to see who's getting the most momentum on the move. So it may be back and forth for a little bit. You'll see it move up, and he'll get a little gain on, and then the sellers will get the upper hand for a little bit and move it down. Well, in that case, you're going to want to watch to see how quickly the buyer or the seller gave in. One will give in a little quicker than the other sometimes, and you'll get a little hint there that the other person's being a little hesitant in defending his area. It's showing maybe a little weakness on his part, like playing poker. So, and these are the things you'd look for. So this is how one would use the Dome to determine what way the market is most likely to go. Now, some people use this for scalping, for 1, 2, 3 ticks and so forth, or scaling in. I don't scalp in that method, so I can't really tell you. I can show you how to look for it and how to go about doing it, but I use it for getting really tight stops at specific levels for a part of a tactic that I use. So if price is getting near the swing high on a daily chart, I'll be looking forward to sell there perhaps, and I'll go to the Dome and I'll start looking to see if I can get in with 1 or 2 tick stop at that level to see. I might get in right at the support level and see if the buyers will continue to get in and get out within seconds, or maybe I'll wait and see if the price, who's going to win out at that level and so forth. All right. One of the best ways I've found to interpret the order flow is by using the Jigsaw trading platform, or the Dome. The Jigsaw Dome shows you not only who is initiating the trade, the market orders, it also shows you how well a price level or levels are being defended with the limit orders. Trading from a Dome is the purest form of trading order flow. The orders that are generated and then flow into your platform, like through the time and sales window I was showing you earlier, they build your charts and indicators. You cannot have charts and indicators without these ones and zeros that are coming through, you might say, like a computer program. They build everything. Everything comes from that. Now you can trade order flow without charts and indicators, but you cannot have charts and indicators without order flow. It's impossible. That's what actually creates them. All right, that said, you cannot find a faster time frame than watching order flow as the flow into your Dome. Okay, so this is the smallest chart time frame I think I know of you can go down to. All right, Jigsaw trading. All right, I've talked to the Jigsaw, to Mr. Peter Davis this week, and just typed to him on Skype, and he has improved, and he continues to improve the product. I don't know that he really knows who I am exactly, because I just typed into him, and he probably got thousands of people typing into him. But he is bringing out more better ways to decipher this information all the time, and he's brought out some new gauges and stuff as well, which isn't included in this presentation because I had made the presentation before they came out, the PowerPoint part of it anyway. But you can click on this or go to this website here and find out more about that. He also has lessons in there, exercises you can do, as well as I do inside my trading course to learn how to use his Dome and so forth. or any dome for that matter, but his dome has more information on it. So let's get down to what it does have. With the Jigsaw trading platform, you can see how many as well as how fast buyers are coming up to the seller's asking price. And you can see how many as well as how fast sellers are coming down to the buyer's bidding price. Furthermore, you can see also how many limit orders are being added or taken away at each price level. So there's a lot of information here in front of you at once, and we have, well, I won't say we, but Peter Davis has exercises. I have some exercises as well in the trading course that you can do to learn more what to look for. So to start out with, you may just be looking at the market orders coming in relation to the price. And then you'll move into looking at the limit orders and so forth. But let me tell you what all it has here first. Now, this may look different than the one you see other people have because this is highly customizable. You can change where the columns go and everything. So the one you look at on another video or something may look different than mine. All right, that said, I have the prices in this column here. So let me bring over a regular dome. The prices in a regular dome are in the middle. On the Jigsaw, I have it off to the left, along with the volume profile telling me where each time somebody trades at each price level, it brings out the collar a little further and gives me a number of how many contracts traded at that price level. All right, with the orange being where the most contracts traded as of when it started printing, recording this information that day. All right, then and one of the things to use the profile for, I'll say real quickly, is if this was a consolidation day and I was thinking the price was working its way back up into here, I would look to sell up here first by watching the orders coming through the market and trade it back to scalp back to here. That's how you would scalp that market, back to the means, they say, or back to the point of control where the most volume took place. And if this gets wider, I'd want a little more room for it. But as price moved down, and I thought price was going to consolidate and move right back into the middle again, I would buy down here and try to sell at the means again, right there. And that can change. And it gets into a lesson on how to trade volume profiling and everything like that as this VPOC moves or this point of control moves here. All right, that's it. This is the volume profile. That's the price. The next column, I'm going to skip it for just a minute and go into the bids. This is the limit orders right here. This column I'm going to show you is this column right here on this particular one right here. And this off to the left of it is where they're adding to or taking away contracts at each price level. All right. And then this is the sell limit orders here. And this off to the right of the sell limit orders are the number of contracts that are being added to or taken away at each price level. It tells you. And as price moves away and comes back, it'll start recalculating the number of market orders and stuff that has went through the market. And these are the market orders right here, or buying at the ask and buying at the bid. So the red ones are where the seller came over to the buyer side and initiated a trade. The blue ones are where the buyer came over to the seller side and initiated a trade. So it tells you who is more being initiating the trade here and how they're defending it. And in this example, you can see that there was 4,190 contracts when this snapshot was taken, traded into the bid, where the sellers came down to the buyer's side. There's another 1,500 that must be absorbed, or not bought, but eaten into, before price can move lower, assuming they don't add any more. But you can see here they've already added 5,731 contracts to this. That means they're defending that level very strongly, and they're attacking it very strongly as well. So I'd be watching to see who won out, and even if they do win out, there's another 4,000 and 5,000 right here. So I'd want to see if they won out here and they do finally blow through all these contracts. Do they start pulling these orders, or do they start defending this area as well? And so forth, or do they start just pulling? This is what you'd look for on the market. And the same thing on the right side, just looking at it from a different direction. But at this point, they've only traded 7 as of the last rotation into this, and there's 1,628 more to go, and they're starting to pull them at this point in time. Now this could change. You'd have to watch. Experience teaches. My words do not teach. They only tell you give you an idea of what to look for. You have to actually get in and start looking for yourself and there are exercises that Jigsaw Peter Davis has made. He has free ones and ones you pay for as well. And then I have them in my course, which you'd have to pay to get to them. Okay. All right. Jigsaw Dome is highly customizable again. You can write in here. I just wrote some stuff in. High day, VPOC, which moved on me the time I took the pick. This is the point of control here in the pink, and it moved down a tick on me once I've done it. But you can write in here where that's at, just to give you an idea. You might want to put the overnight low or something like that in there. And then the volume profile here, again, you'd want to sell. If this was a consolidating market and price moved back up into this area, you might want to look for a selling opportunity and try to sell it back down into the mean here where the point of control is, or buy and hope, and then see if price moves back to the point of control again here. And then we have the split profile here, and we go through this. Each one of these slides show what each thing is. The volume profile, the price, where the price is at the bid right now, this gray shaded area where it last traded. This shows where the buy limit orders are and stuff. You can slow the video down and look at it if you like. The split profile again over here, where the limit orders are, where the market orders or those initiating, who's coming over to the sellers or the buyer side. The sellers come over to the buyer side there. The buyers come over to the seller side, and the limit orders that are being added or pulled. And then we go to the split profile here. And then this is something that Peter Davis had put on that I took a snapshot of to add in here. And this may have changed because he's always improving it, it seems, or he has in the past, as when I made this video anyhow. All right, now we're going to move to the footprint chart. All right, a footprint chart lets you look inside a price bar to see the number of contracts being traded at each level of price and who is initiating the trade. So what it's doing is like when I showed you on the Delta wall go, it's showing you who's coming over to the sellers. Each time a seller or sellers come down and accept what the buyers are bidding, it is tabulated and recorded in this column. So this shows sellers coming over to the buyer side. Remember, this is the buyer, the limit orders. They're coming over and accepting the limit orders there. They're coming over and eating into them the limit orders. And at this point in time, there was 0 at price level 55.97. 0 come over and initiated the trade at that price. The next price level down, there was 5 came in and initiated the trade to sell into the limit orders right there. So there was 5 aggressive, 5 initiating the trade, 35 here, 55, so on, so on. And we'll tell you why they're red and green here in a moment. We'll get that on the next slide. And so all the sell limit orders coming in, or all sell market orders coming in, are registered on the bid side. All the buy market orders registered on the ask side. So again, real quick, buyers coming over to the seller side and accepting and eating into these limit orders. Sellers coming over to the buyer side and eating into these limit orders. That's what's happening here. Those are initiating the trade. So you can see who initiated the trade in each candlestick, and the candlestick will be in the middle on this particular footprint chart that I'm going to show you here in a moment. All right. All right, now we're going to look at a footprint chart, and I'll tell you where I got the footprint chart and everything at the end of the thing here. And it's practically free. So where they want thousands of dollars for some of these things. All right, on the left, the candlesticks are the number of contracts at each price level that sellers came down. So again, I'm just saying the same thing I said a minute ago. On the left is who initiated the sellers coming over to the buyer side and initiating the trade, trying to drive price down for the most part. All right, and then if they're on the right, it's buyers coming over to the seller side, trying to eat away at the sellers' limit orders and push price up. All right. And then we have a profile over here with the number of contracts traded at each price level as far back as I have this thing set to go in time back on this, and then the price over here. All right, most volume that occur. Okay, the blue hash marks on either side of these price bars that I have here tell me where the most volume took place inside that price bar. There's more volume took place at this price level than any other price level in that candlestick, and the same with each candlestick where the most volume. And what you want to watch for is where this occurs in the bar as price moves along. Is it moving up in the bar or down in the bar as price moves along? And see, that'll give you an idea of who's got more control of the situation. If I start seeing the volume moving down, then the sellers are probably more in control of the situation. If it's sitting near more the top, the buyers, it depends on whether it's at a support or resistance level. If it's at a support or resistance level, I like to see the most volume took place in the bar as it's close to that support or the bottom of that candle as I can. If it's at the top, I like to see the most volume at the top of the candle as I can, telling me that's where all the volume took place, because that's where the battle took place to turn this thing around, to move to initiate a reversal. So I like to see it at the bottom at a support level and at the top of a resistance level. I like to see the volume at the top of a resistance, the most volume that took place if it was hitting a resistance level, and at the bottom if it's hitting a support level near the bottom, within the first three ticks of the bottom anyway. All right. In an auction, there are always two prices. We went over this. What someone is willing to bid and what someone is offering or asked. And the bid will always be above the ask. They're always trying to get as least amount as they can. You want to get as cheap as you can if you're buying something. If you're selling something, you want to get as much as you can out of it. So you don't read these right to left. You read them from lower left to upper right. Remember, there's two prices, the bid and the ask. The current price is at the bid here, and the ask is right above it. So those are the two prices we're fighting at the moment at any one time. So this is what this is registering, the bid and the ask on this dome. This is what I want to look at. This is how I look at the price. I don't look at them from right to left. I look at them from lower left to upper right to tell. And you can stop the video and read more if you can't understand what I'm saying. And again, the blue hash marks is where the most volume took place. All right, now we're going to look at stacked imbalance. When you see, let me go back to this a minute. When you see the red, this turn red and the font turn red, that tells me that there was at least 150%, and I should have covered that right here, 150% difference between the ask and the bid. You know, some people you can set these to any percentage you want. I've set mine at 150. Some people like 400, 500, 1,000. It just depends on your strategy and what you're trying to do. Me, I just want to get an overall direction immediately, and I set it pretty low, 150%. All right, that said, if I, let's see, imbalance occurs. Okay, we're just talking about imbalance at the moment. I don't want to get ahead of myself. So in this candlestick, there was more sellers, percentage-wise, coming over, or more buyers coming over to sellers coming over to the buyer's side than there was buyers coming over to the seller's side. So it was dominated by more aggressive or more sellers initiating the trade in this candlestick. However, in opposed to this candlestick where the buyers had more than 150%, it turned to green and showed it was more than 150%. 276 is more than 59%, and you can kind of get a gauge on it here, 53 about the percentage of it and stuff, how strong it is. So it just gives you an idea of that and makes it in green for you. All right. Now, stacked imbalance is where I have three or more of them together at one time, stacked right on top of each other. So if price is moving down in a down stick, I like to see this in the lower portion of the stick, or in the whole stick would be nice, but at least in the lower portion of the stick, where there's three consecutive of more that is more than 150%, or whatever setting you want to set it at. So that's what stacked imbalance is. An imbalance of more than 150% or whatever percentage you want to set it at, showing up with the font turning red, one right after another, at least three. That's what I'd like to see to know that there's a pretty strong selling in that stick. And if I get that in a stick and the price still closes on its highs, then I know they got absorbed by the limit orders is what happened. So this is another thing you got to look for. And I'm not trying to teach you how to trade this right at the moment. I'm just teaching you some of the things to look for. But that is one of the things. If this thing would close on its highs and I'd seen that, I know they got all absorbed. And the buyers had control of the situation. They defended their area, and then they took control of the situation. In this case, sellers clearly had it. In this case, buyers clearly had it. So, but if this would have been a red stick, I'd know they got absorbed, and the sellers would have took control of the situation. I'd look for that. So these are the things you look for in it: the stacked imbalance and so forth. Now we're going to look for sequence decline. As price is moving up, now this is a support level right here that turned into a resistance level. Price moved down, came pulled back to what was once support. Now it's made a resistance level, and I see a lot of aggressive selling or them initiating the trade in that candlestick. And I see there was 218 as price tried to move up, and you'd want to watch this as it was occurring. You know, like again, this is order flow. You can't stick your hand in the same river twice. The water moves. So you don't know until the candlestick's done being made if these numbers are going to stay the same, and you want to see them as they're occurring. So if this ran up and done this as it was doing it on the run up, that's what I want to see it on the run up, not as it was moving down, seeing some more numbers added to it. I want to see it as it's moving up. Then it was 218, then it was only 125, then it was only 13. You know, the buyers just found no interest. There was no buyers willing to come up to the other side then. So, and they got weaker and weaker to come up. So sequence declines, what I was looking for right there. Then I would look for, after seeing the sequence decline, I'd want to see this red come in after that. I'd want to see heavy selling come in after that. So it's the flow of orders and what is happening in the flow. A still picture really cannot tell you exactly what happened. I can just give you some reference points there. All right. And again, here's sequence decline to the downside. Again, I'd want to see this coming in on the way down. I'd want to see price pushing down with lesser and lesser and lesser. And then as price start to move up, I'd like to see the buying increase on this side. So this could have been an area where I would have bought, depending on how I seen these numbers come in. Not necessarily they look great right at the moment. How did they come into the market? All right, that's what I'd look for. All right, and then unfinished auction. All right. I had somebody trying to sell me one of these delta or one of these footprint charts a while back, and I asked them, well, how do you know this is an unfinished auction? Testing them to see if they know what they're doing, and they didn't really know why it was an unfinished auction. They just said this: if you see the zero, if you see numbers there, that means price is going to come back to it. Really, that's all you need to know, really, anyway. But if you really want to know why this is an unfinished auction, I'm going to tell you why. There was sellers willing to come down to the buyer's side and trade here. 22 of them. That means they were still willing to do business. Whereas over here, there was nobody willing to do business at that price. No sellers was willing to come over and do business here. So there was no unfinished business, no unfinished auction, whatever they want to call it. So the premise is this price here, price will eventually come back and finish this auction, which in this case it did. It moved down a little bit, it pulled back, and it came back by one tick, but it did finish the auction and leave a zero here. There was no sellers willing to come over to the buyer's side and trade here. There was no, the auction was finished. There's just nobody willing to come there. That's what the unfinished auction is. That's what the unfinished business is. Here's one on the downside. We see price coming down, and we see the unfinished auction here. There was no buyers willing to come over, or no, yeah, buyers come over to the seller side and trade. There was willing to come over, 22 of them. So that we've seen that there was a willingness here, but the price went up anyway and left them behind. And then it came back and finished the auction. So what they're saying is, if you see two digits at a swing low like this, more than likely price is going to come back and work its way back through that. Now, whether it's going to keep going or just come back by one tick like this one did and move back down, you don't know. But that's the premise of it. It's going to return to that price eventually. Up here, we see we have an unfinished auction here of only 5, only wanted to come down, and price is still moving down. But according to what they say, price should come back to this price eventually. Now, it may take it days, weeks, months, or years, but it may come back in 2 or 3 minutes as well. So that's how that works there with the unfinished auction. All right, range confirmation charts. Now, I use these to get in. I'll look for a support or resistance level, that daily or weekly, monthly, or something like that. And when price gets near that level, I'll start looking at this chart to take a trade. Otherwise, I don't really care. Now, there's other ways you can trade using this chart, of course, but this is what I use it for. So as price was coming down, and say I was coming down and I broke down through a support level up here somewhere, I don't have it marked, but say I come down through a support level, and price started giving me positive delta. So it gives me more delta here. I see weaker momentum right here. So price moved down, but the momentum was moving up. So I might want to take a trade given what I see the flow of orders. It depends on how these orders come in the market will determine whether I got in right here or not. All right. But I did have an unfinished auction. There was buyers willing to come over to the seller side this time. So it may come back around and come back down to that again. But we don't know how far it's going to go. You know, you'd have to do your research and your testing to find out how often things work and how far they work and so forth, and where your stop should be and all that stuff. That gets into strategizing and such. All right, let's look at another one here. This is a support level that I've dashed it now, but it was solid at one point. Price is coming down, testing this level. We got strong stacked imbalance to the downside. We got strong delta to the downside. And then all of a sudden, momentum weakens. The sellers are starting to die off. And the delta starts turning positive. And then this would have been an area that went long right there. And we did have an unfinished auction, so it's more than likely going to come back down and retest this level again. Now, what else am I forgetting? Let me think here. All right. I know that there's another way of trading. Like you see, if the price has moved off a price, I can't move the chart back. Is what I'm trying to do, and you can't do it. It's a picture. But I've seen all this selling, stacked imbalance here. You may want to join the bid here as a seller. Sell into the bid and join this, thinking that price won't go back above this bar. You know, by seeing all this. This is one method, a breakout type trade here. And you may be able to get a pretty tight stop. You might join the bid in here and only have a 3 or 4 tick stop right there. And watch it go down until you get a positive delta and then get out. I don't know how often that works because I haven't tested it out, but that's one method somebody might teach how to do this. They also use volume clusters where the volume accumulated. Now, I don't think this particular indicator will tell you that, but there are some out there that do, and they're rather expensive compared to the price of this one anyway. But they'll tell you where accumulation of volume occurred over a certain price. But you can also look at it here and see it on the volume profile, where the most volume took place over every time price got near it. Ever since this, ever how many days I got this going back. If I got it going back 1, 2 days, it'll measure the volume all the way back for ever how far I got it going back. So you can see where there's concentrations of volume at. And that's where it might be a support or resistance level. That's another means of trading this right here and stuff. And there's several ways to go on about doing it. Now, I teach to watch for support and resistance levels, and I like a big risk reward. I like to have, I can have a really low win rate. I can only be right 20% of the time and still make money. Now, my win rate's a great deal better than that. But it's because my risk reward is really small. I only risk sometimes 3 to 4 ticks on some of these trades, and they'll go 50 to 100 ticks sometimes. In the crude, is this crude? Yeah, crude oil here. It'll go 50 to 100 ticks sometimes. So I got an extreme risk reward. So that's how I work it. Some people go for just a few ticks each time and get a really high win rate, but you got to maintain the win rate. And I go into this all in the course in great detail. All right, here's another one real quick. I think this was a real trade. I'd have got short right here. It was testing the high day. I got the stacked imbalance. I got the weak momentum. Concentration of volume took place right here. And it did come back up. It was an unfinished auction, you see right here. And it did come back up and finish the auction. But my stop would have been 3 ticks above this swing high, the way I work my stops. And if I got in right there, so this would have been like a 12-tick stop on this. If I'd have got in right there, I might have joined the bid in here. It depends on what I'm seeing at the time. And this takes discretion. If you want to do it mechanically and you see this, you get in right here with a 12-tick stop. And I always figure for crude oil, you got to figure for slippage and stuff like this. And I go into the course on all this, on how to go about doing this and everything. And you won't know what I'm talking about really until you actually trade crude oil to see how it moves. All right. And all right, now how do you get that footprint chart? The Jigsaw platform you got to buy from Peter Davis. I'm not sure how much the platform is now. I think it's $500. I have no idea. It's been a year since I bought it, 2 or 3. And then if you want to trade off of it, I think you got to pay him a fee for the Jigsaw trading platform. But if you're going to scalp, it is invaluable. It's really invaluable for even doing what I'm doing. Use, or I wouldn't have it wouldn't be telling you about it. All right, the footprint chart can be found at Futures.io or what was once called Big Mike's Trading Forum. It costs now, I believe, $100 to get in. I got in several years ago. I think it was only 50 then. That's dating me. It's probably been 10 years ago. Uh, I got in on that, but they have indicators in there that you can move over into NinjaTrader. They also have them for other platforms like M4. I don't know, some different platforms they have out there, but they probably got 200 indicators or more just for NinjaTrader 8, and they probably got several, probably 500 or 600 for NinjaTrader 7 platform. So, but this is, I got this one for NinjaTrader 8. It costs $100 to join their forum, and the forum's free for if you just, I think if you want to go in and just chat. But if you want to get all their goodies and stuff, it's $100. It's a lifetime membership, far as I know it was when I joined anyway. And I highly recommend joining the forum. And the indicators alone will pay for it, because I also own the North, an indicator for this, which last I seen was $6,500 now for a footprint chart. And then there's Market Delta, and I think he's $200 to $300 a month. I don't know, but he has a really nice footprint chart as well, and so does the North. But then again, this one is free if you join the platform, and it gives you everything. It gives me everything I need to do the kind of trading I'm trading. Now, if you want to get more intense on it, you may want to consider buying the North or joining Market Delta, or there's some other platforms out there for sale as well. But you can't beat the price on this one. It's just, it's just fabulous. And the Delta indicator that I showed there, that's from, I think NinjaTrader has it in their package now, but you can also get it from the forum as well. And I think that about covers. This thing's went an hour and 21 minutes, so we'll see how it downloads or uploads. And if you have any questions, you can just email me. Be sure and if you found value in this video, subscribe to me, hit the bell there to be notified of new videos, and trade well out there.